You'd probably expect a retirement specialist like me to big up money purchase personal pensions. In this 444, I'm sharing my 4 reasons why I think they rock. Firstly, there's no corporation tax or capital gains tax on the money inside your pension funds. As a result, they will grow tax-free. Secondly, there's reduced tax on you. There's no capital gains tax on you if you sell a pension fund. And there's no inheritance tax if you die. Your pension fund is outside your estate for inheritance tax purposes as long as it's distributed within 2 years of your death. Most people can withdraw up to 25% of the value of their pension fund as tax-free cash, now referred to as PCLS or Pension Commencement Lump Sum. Now there's a limit of £268,275 on tax-free cash, which is linked to the recent abolition of the lifetime allowance. But very few people will be impacted by this. You can take tax-free cash once you reach 55, but this is going up to 57 in 2028, and I've done a video about that up here. Any withdrawals in excess of the tax-free cash entitlement are taxed as income at your usual rate of income tax in the tax year of the withdrawal. When you make a contribution to a personal pension, the government adds money to it. This is tax relief. It's free money and it's available on all personal contributions up to the annual allowance, which is currently set at 100% of relevant earnings or £60,000, whichever is the lower. Basic rate tax relief is applied at 20% for the pension contributions that you make. Higher rate taxpayers can claim an extra 20% and additional rate taxpayers an extra 25% via self-assessment or an amended tax code. Let me explain how tax relief typically applies. If you put £80 into a personal pension, the government will put in £20, adding up to £100 in your pension in total. The £80 you pay is known as the net contribution. This is the contribution before any tax relief is applied. The net amount is just the amount you pay. The £20 added by the government is known as your tax relief, and the total contribution of £100 is known as the gross contribution. It's made up of your net contribution of £80 plus the government's tax relief of £20. The £20 from the government is equivalent to 20% of the total £100 pension contribution. So that's basic rate tax relief. The thinking is that because you've already paid income tax on your earnings, if you put those net earnings into a pension, you should get the income tax back that you've already paid. This is just one of the ways that the government encourages people to save for their own retirement. And if you're a non-taxpayer or a basic rate taxpayer, that's all the tax relief you're going to get. But if you pay higher rate tax, i.e. 40%, or additional rate tax, 45%, then for you, there's more. Higher rate taxpayers get another 20%. This is given in the form of a tax rebate. On the £100 gross contribution from earlier, there's another £20 back, either as a cash refund or an amendment to your tax code. So you pay less tax via PAYE on your future taxed income. So technically, the £100 in your pension only cost you £60. So the tax relief here is £20 into the pension from the government, that's the basic rate relief, and another £20 in the form of a tax rebate. This is the higher rate tax relief. For additional rate taxpayers, the additional rate relief is 25%. So that's a rebate of £25 on a £100 gross contribution. With such generous rates of tax relief on offer, there's understandably a limit on contributions into personal pensions that can benefit from tax relief. This is the higher of 100% of relevant earnings, which is capped at £60,000, or £3,600, whichever is the higher. Any unused allowances from up to the previous 3 tax years can be carried forward to use in the current tax year, but you must have supporting relevant earnings in the current tax year and have been a member of a registered pension scheme in the previous tax years to use up carry forward from those years. You must also use the current year's annual allowance first, and if you have unused annual allowances from more than one previous tax year, you'll need to use them up in the order of earliest to most recent. So if your relevant earnings are, say, £30,000 per annum, the most you can put into a personal pension is £30,000 gross, i.e. including basic rate tax relief, which means the maximum amount you put in is £24,000 and the government will add in £6,000 tax relief. You cannot carry forward unused annual allowances from previous tax years because this year's £60,000 annual allowance has not been fully utilised. But if your relevant earnings were, say, £100,000 per annum, then you can contribute up to £60,000 gross into a personal pension. That's a £48,000 contribution from you and £12,000 of basic rate tax relief paid in by the government. There'll also be an additional £12,000 tax rebate to cover the higher rate tax relief. If you also have up to £40,000 of unused annual allowance from any of the previous 3 tax years, then the contribution limit increases to £100,000, i.e. 100% of relevant earnings. When you die, and you will definitely die by the way, any unused money in your personal pensions, whether it's uncrystallised or in drawdown, can be inherited by your beneficiaries, free of inheritance tax. If you die before 75, the inherited pension can be withdrawn free of any income tax at any time. If you die after 75, withdrawals are taxed as income on the recipient of those withdrawals in the year they make those withdrawals. Your beneficiaries can cascade any unspent personal pensions onto their beneficiaries. The main way I see people benefiting from inheriting pensions is by couples being able to inherit each other's pensions. This enables the same withdrawal strategy to continue for the surviving spouse even after their partner has passed away. This can help offset the loss of some or all of the deceased partner's state pension. Now this video is all about getting your money into a pension, Jim Yap, and this one is all about getting your money back out again, Jim Bower. Thanks for watching, and I'll see you in the next video.